Hello, and welcome to another stock analysis on Stock Market Palantir. Don't forget to subscribe and drop your comments. Now, let's go hear our analysts.
Welcome to the Stock Market Palantir. Today we are going to talk about PETS.
PetMed Express Inc., ticker PETS. And what a story this is. It's really a textbook example of extreme corporate distress meeting, well, some very opportunistic capital.
It really is. I mean, this isn't just a stock chart we're looking at. It's a whole narrative. It's a story of a massive governance failure that just culminates in this forced acquisition attempt in, December of 2025.
Exactly.
And the recent price action, that's what really defines this story for me right now. This stock had utterly collapsed. It capitulated to a 52-week low of just $1.57. Then, in early December, everything just reverses violently, all spurred by this unsolicited, all-cash acquisition proposal from Silver Cape Investments. And that bid valued the company at $4 a share.
The effect was just explosive. You have a stock at $1.60 just before the news breaks, and then a $4 offer lands. That's a premium of, around 150%? So the market reacts immediately. You get this classic gap up, and the stock pushes right into that $3 to $3.60 range where it's sitting now, just aggressively narrowing that arbitrage spread.
And that rapid, violent repricing is really the focus of our exchange today. We have to try and figure out, is the current valuation, this $3 plus price, is it fundamentally justified by the deep value residual assets that made PETS an acquisition target to begin with? Or is this price strictly a transient, event-driven arbitrage opportunity, fueled entirely by market microstructure mechanics and the forced unwinding of short positions?
Well, I'm going to argue that the price absolutely reflects the underlying financially sound asset value. The market was simply incapable of pricing this business correctly because of all the managerial and regulatory failures. And that $4 bid is just confirmation of that intrinsic worth.
And I'll be arguing that the current price is primarily a function of that market microstructure, the mechanics of the merger arbitrage, but really amplified by extreme short positioning and the illiquidity that just provided the rocket fuel for the move.
Okay, so let me just articulate my position on the fundamental value proposition first. I come at it from a different way. Silver Cape didn't offer $4 out of charity. They offered it because the underlying business was trading at a massive, an undeniable discount to its operational and its liquidation value. The public market was just blinded by all the governance problems, and it had created an absolute bargain.
Right. I see why you think that, but let me give you a different perspective on the process of that repricing. That violent move to $3 plus, that's not the result of deep value being slowly recognized. It's a structural market reaction. A merger arbitrage adjustment that was amplified by the extreme short positioning and liquidity constraints. You just have to look at the key metric here. The days to cover ratio is sitting at an exceptionally high 10.07.
Okay, that is certainly a high ratio, meaning it would take, over 2 weeks of average trading volume for shorts to get out of their position. But I see that as a symptom, not the cause. The short sellers were there because they were exploiting clear financial decay. Silver Cape, on the other hand, they looked right past the decaying revenue and focused on the balance sheet, which is pristine.
And that balance sheet is, it's the core of your thesis. They reported a strong cash position of approximately $54.7 million as of March 2025, and critically, zero long-term debt.
Exactly. And for our listeners, just think about the implication of that offer. The $4 per share offer implies a total equity valuation of, let's say, roughly $85 million. But if you net out that $54.7 million in cash, which the acquirer essentially gets back after the purchase, the enterprise value, the EV, implied for the actual operating business is only around $30 million.
So you're arguing that for $30 million in enterprise value, Silver Cape is getting the company's valuable customer list, the pharmacy infrastructure, all the licenses. That is a stark dislocation.
It proves the dollar for 50 cents thesis. They are requiring a massive consumer database and a functional operating system for a nominal $30 million EV. That extreme dislocation, which was caused by accounting and governance failures, it made this deep value play inevitable. So the bid is the result of pre-existing value, not simply the cause of the price movement.
I'm just not convinced by that line of reasoning because the path to $4 is defined by market mechanics, not just the logic of the value. The current high price is a forced movement. It stems from the mechanical need for shorts to cover after the news. This creates immediate volatile pressure in a low float, high short stock. Let's shift our focus to the accumulation phase, because I really challenge the idea that this value was just passively realized. The acquirer had to use some very specific technical strategies.
Tell me more about that, the technical strategy.
Well, we need to look at the institutional positioning leading up to the bid. If this was such clear, deep value, why was so much of the accumulation kept hidden? We saw extremely high off-exchange short volume ratios in the weeks before the announcement, frequently exceeding 30%. But more striking is that 67.47% of the volume traded at the stock's absolute nadir, down in the $1 to $1.05 range, was executed in dark pools.
That 67% dark pool figure, yeah, that's highly significant for anyone trying to understand microstructure.
It suggests sophisticated actors. We can assume Silver Cape, who accumulated an 11.1% stake, used off-exchange venues, these dark pools, to accumulate a massive 2.3 million share position without alerting the lit exchange price. For listeners, a dark pool is it's essentially a private exchange where large trades are executed away from the public eye. So by routing volume there, Silver Cape prevented their own buying pressure from driving up the stock price prematurely. It allowed them to leverage the distress and acquire their initial stake cheaply.
Okay, I acknowledge the use of dark pools. That is the sophisticated acquirer's prerogative. It's standard practice for a large institutional accumulation when you intend to take a controlling stake and, maximize your price leverage. But using dark pools doesn't negate the fundamental value premise. It only speaks to how efficient the acquirer was. My question is still, why was the stock allowed to trade down to $1.57, enabling this in the first place? That's where the fundamental decay is paramount.
The catastrophic governance crisis that just shattered institutional trust.
Precisely. The core issue was the regulatory crisis. It was centered on the restatement of revenue. The company had historically recognized vendor-funded programs as a revenue, but then scrutiny determined they should have been recorded as a reduction in cost of goods sold in COGS. So this restatement, it just destroyed the top-line integrity and shattered institutional confidence, causing a systematic flight of capital and, enabling the deep discount. The acquirer was able to hide their accumulation because the fundamentals had become so compromised that everyone else had written the stock off.
Okay, so we can agree the underlying corporate decay created the opportunity, but the current trading price is absolutely dependent on the event completing. So let's look at the deal certainty, which is where all the arbitrage risk is focused.
Well, from a fundamental perspective, the deal quality is extremely high, which supports the current trading price. Silver Cape's proposal is explicitly not subject to a financing contingency. They're funding the purchase with cash on hand. They already deployed over $10 million for their initial stake. This commitment removes a massive execution risk that typically plagues microcap M&A, and it establishes a much firmer $4 floor for the transaction than we typically see.
That's a compelling argument. But have you considered the structural hurdles posed by the board's defense? The current board is fighting back and fighting back aggressively. They're protecting their position with a poison pill, a shareholder rights plan, which they adopted just before the bid became public in late November 2025.
The 12.5% threshold, right? This is the mechanism designed to stop Silver Cape.
Exactly. Since Silver Cape is currently capped at 11.1% ownership, they can't buy any more shares to increase pressure without triggering that pill. For the audience, the pill would basically flood the market with new shares at a discount to existing shareholders, massively diluting Silver Cape's stake and making the acquisition prohibitively expensive. The deal is far from certain. The board is under a fiduciary duty to either fight for a higher valuation, maybe shop the company to a white knight, or risk the whole deal collapsing.
But the risk of the deal collapsing is exactly what you should weigh against the regulatory risk.
Yes, and that current trading price, that deal spread between 3 and 360, it reflects the market skepticism that the board will just redeem the pill and accept the $4 offer without a fight. If that resistance succeeds, the stock collapses back toward that $1.50 fundamental floor we talked about. The price is pricing the execution risk, not the fundamental value.
I appreciate the structural risk, but that resistance is ultimately constrained by the company's precarious regulatory position. The board has very few good options if they reject the $4 cash offer, which to me is why the deal is likely to proceed.
And that brings us to the threat of regulatory delisting, which, in the absence of the deal, is an existential threat. The company is already in non-compliance with NASDAQ Rule 5250C1 for failing to file their Form 10K and 10Q on time. They are on a very strict timeline.
That inability to file is a classic signal of a firm in distress.
If the deal collapses, the board's plan B is almost certainly a highly dilutive reverse stock split, say a 1-for-5 or 1-for-10, just to regain that minimum $1 bid price they need for continued listing. And that move is, as we know, generally viewed by shareholders as a signal of a corporate death spiral. The current price avoids this death spiral only because of the binding acquisition bid.
I would argue that the NASDAQ filing delinquency is the strategic rationale. I mean, Silvercape's entire premise is that PetMed Express would be best positioned as a private company. Taking the company private eliminates the immense, disproportionate costs of public listing, the legal, the audit, the NASDAQ fees, all of which are just crushing this distressed microcap.
So you view the regulatory pressure not as a risk to Silvercape, but as a feature that actually strengthens their leverage?
Precisely. They have $54.7 million in cash. That cash pile is more than sufficient to fund a private turnaround, streamline operations, and eliminate the exact pressure the NASDAQ compliance issues represent. If the deal closes, the regulatory issue becomes entirely moot, and the intrinsic value of the operating business, which they acquired for a remarkably cheap EV, is immediately unlocked. The valuation is underpinned by the cleanup potential created by the prior fundamental decay.
I find that to be a powerful argument, but it still places the entire investment thesis and the current $3+ price on the successful execution of an M&A event, not on stable operating fundamentals. The technical factors just cannot be ignored. The high days-to-cover ratio, that illiquidity trap, means that forced buying by short sellers is likely contributing significantly to keeping the stock tight in this arbitrage range. We are seeing a technical short squeeze dynamic driven by M&A news, not a pure fundamental re-rating based on future profitability.
And while the squeeze introduces volatility, it's temporary. The value Silvercape sees is structural and permanent, a business with zero debt and a huge cash balance. The anchor point is the underlying value of the assets being bought for $4, which is supported by that strong balance sheet. The deep value was the necessary prerequisite for the arbitrage opportunity to even exist.
So, in summary, the distress created by corporate failure exposed the underlying value, the strong balance sheet, the cheap EV, making the company a financially irresistible target. The $4 is a fair reflection of buying a valuable asset base.
Whereas I would summarize by saying that the path to $4 is defined by technical, volatile market mechanics, arbitrage, and a potential short squeeze, and not stable fundamental valuation. The price relies entirely on the successful resolution of the boardroom battle against that poison pill.
While this case study perfectly illuminates the complex interaction between fundamental decay, which creates financial dislocation, and activist capital, which then exploits market microstructure to monetize that dislocation, the listener really has to weigh the probability of the event, the success of Silvercape overcoming the pill, against the undeniable clarity of the underlying asset value that made this whole scenario possible.
Thank you very much for hearing us. Let us know in the comments what is your opinion and if you want us to analyze other stocks. Don't forget to subscribe to the Stock Market Palantir channel to catch up with more stock insights, and see you in the next video.